1.4 billion people are unbanked. Imagine you only have a smartphone in your hand. And thanks to this phone, you can sell products to a customer in Germany, the United States, and even on the Asian market. You can also invest in the New York stock market and the Tokyo market too. All this with fintech. Many people might hear us talking about fintech. What does fintech mean?
Fintech is the use of technology to improve, automate, and democratize financial services for everyone.
Today, our guest is Jeff. Jeff worked as an executive at the Central Bank of Haiti and several commercial banks. Jeff is an expert in fintech and quantitative economics and co-founder of the fintech ecosystem of Haiti. Jeff, can you tell us why the world has changed these rules?
The rules have changed in today's world because of technology, because technology has managed to remove all existing monopolies. Imagine a country chooses fintech. Its population living in rural areas gets access to sell on the international market. They can sell their goods, run their business, and receive payments. This could be a giant leap for that country's economy, lifting it out of poverty and moving it to a truly extraordinary level of development.
How's it going, Jeff?
I'm doing great, and you? How are you?
We're doing well. The global economy is no longer reserved for someone with a diplomatic passport or a powerful passport, or just someone with a bank account in a country like Switzerland, for example. It is now accessible to everyone who has an internet connection and a smartphone. This is one of the biggest shifts of this century. And since 2010, there are over 1.4 billion unbanked people who have access to a mobile. This isn't the Industrial Revolution anymore. We've heard about the Industrial Revolution, which was about machine development, but this is now the digital financial revolution. We see the world changing. Jeff, can you tell us why the world has changed these rules?
Thanks, Romain, for the invitation to talk about fintech, why the world's rules are changing today. The rules have changed in the world today because of technology. Because technology has managed to remove all the monopolies that existed, it allows you to create a range of things remotely. For a long time, small countries had to, for example, go through international institutions so they could have access to the international economy, like having to go through the IMF, World Bank, and correspondent banks to participate in the global economy, as I said. But now, because of technology that allows them to develop digital platforms and connect with other countries. I'll give you an example. An entrepreneur or a producer within a country can connect with anyone living anywhere. Someone in Jacmel, for example, in Haiti, can directly be a customer of someone in Berlin, Germany. And all of this is possible thanks to technology. This really is a fundamental change in how people access markets and the conditions under which they can connect with others.
Okay, Jeff, that's interesting because the world itself has undergone a technological shift. We see technology, as technology develops, we see that people are getting more access to the global market. But Jeff, many people might hear us talking about fintech, but they don't know what fintech means. In a few words, can you explain to people what fintech means and what fintech actually encompasses?
As we hear it, fintech is composed of two words, which are fin and tech. And it's a contraction of two words that gives you fintech. The first word is an English term, which is financial. The second word is technology. When they're combined, it becomes fintech. What fintech is the use of technology to improve, automate, and democratize financial services for everyone. It's not a sector in itself, but rather a new way to conduct finance. Faster, cheaper, and more accessible to everyone, excluding no one. It beats what we can call the traditional system where you have to walk to a bank. Because of technology, fintech allows you, wherever you are, even in a rural area, to have access to financial services and products. That's what fintech is. It's through technology, through the phone you have, through a smartphone, through a computer, you can have access to financial services and financial products. For fintech has four fundamental pillars. Before I mention all the sectors that fintech encompasses, we can say that fintech is built on four fundamental pillars. The first pillar is access, where you can open the system to everyone. The second pillar is speed, where transactions happen in real time. The third pillar is the cost. Generally, when using banks, costs can be very high, but because of fintech, costs have really decreased. Meaning this is a pillar for fintech where it reduces transaction fees for a person. The fourth fundamental pillar that fintech has is what we call data. Because of the data we have, we can make decisions based on analysis. Okay, these are the four fundamental pillars that form fintech. Generally, people think fintech is just one way, like banking, but no, fintech rather encompasses four main sectors. The first sector is what we call digital payments. payment systems where you can send and receive money without traditional banks in a second through your phone. For example, in Africa, there are systems called M-Pesa, Cash App in the United States. We have Stripe. We have PayPal. In Haiti, we have Moncash. Okay, these are digital payments. The second sector we can say is what's called neobanking, which is a digital and inclusive bank, where this bank, without a physical branch, gives you access to accounts, you can save, you have access to credit, all on an application.
Using a phone the person has in their hand, and
Obviously,
the person has their bank account, all that.
because of the phone, you have access to a bank account without needing to go to a bank physically to be able to have access to everything I just mentioned. For example, I can tell you that in this sector, we have what's called Chime, we have Nubank, we have Kuda, we have N26, meaning these are examples of neobanks. We have the third sector, what we call digital credit. Digital credit, where you can take loans with microfinance, where you can access credit without traditional collateral, and it's based on data and alternatives with artificial intelligence. For example, we have Tala, we have Branch, okay, we have Jumo, we have Kiva as examples of companies in these sectors. The fourth sector we can say is for fintech is what we call remittances, okay, which is when people send money, which are international transfers, where you in the United States or you in France or you in Germany have family abroad or a colleague abroad, you can send money to them, where you send money to your family overseas faster and at a better price than the terms we know, like Western Union, Cam Transfer for Haiti, MoneyGram, these systems that we are familiar with. In this category, we can give some examples like there's a company called Rise, there's Remitly, there's Sendwave, there's World Remit. To mention those in this category, that's the remittance category, which is the fourth sector that fintech encompasses. The fifth sector itself is what we call crypto and blockchain that we've all been hearing about. In this sector, we have what's called digital currency and DeFi, where we find decentralized financial services without using an intermediary, without having a central bank to regulate, a central bank as usual in all the traditional systems we have a central bank there that's in charge. In the crypto and blockchain pillar, we don't need the intervention of a central bank. In it, we can cite a few examples. We have what we call Bitcoin, we have Ethereum, we have stablecoins, we have DeFi, okay? To name those. In the sixth sector, we can talk about what we call insurtech. Many people might be surprised when they hear insurtech. In insurtech, we see insurance, meaning we can say, okay, how does insurance fit into fintech? But effectively, insurance is within fintech, where we find what's called digital insurance, where insurance becomes more accessible to everyone with a lower price. And it gives people who didn't have access to insurance in the past, it becomes more accessible to everyone. Even if the person is in a rural area, they don't know what insurance is in traditional systems. They had to have a lot of money or they had to leave the place where they were to go to another place. But with InsurTech, you can have access to insurance where the process goes faster and the prices are fairer. We can mention in this category, we have Lemonade, we have Bima, we have Turaco, that we can mention these types of companies that are in InsurTech. In the seventh sector, we can talk about wealth tech. So I know you like using the platforms, you like the trading side, those kinds of things. Well, all of those are fintechs. It's in the category that we call wealth tech, where you can make investments and you can pay electronically, what we call ePay. This sector democratizes access for a person to the global financial market. As you said, it means that someone in a rural area, a farmer in the fifth communal section of Akwin, through wealth tech, that person can invest the money they have in the financial market of any country. It could be in the United States, it could be in Europe, it could be in China, anywhere, but with a lower cost. In the past, for that person to be able to make investments, they had to have a broker, to contact a broker on Wall Street, pay them a lot of money to manage their account, etc. But through WealthTech, with just one application, that person can invest as they wish in a financial market in any country in the world. In this category, we can mention platforms like Robinhood, we have Acorns, we have Cowrywise, as if we can mention in this category. There are a lot of others, but I'm only mentioning these. The last pillar, which is the last category, we can call it that, is what we call RegTech. Okay? In Reg, what we see in it is regulation. That means there are some fintechs themselves that are managing regulation. This fintech is based on what we call compliance with regulations. And it's a technology that allows the institutions in fintech to respect the legal rules. The legal rules, which are what we call KYC, which means know your customer. We have AML, which is anti-money laundering. These two on an international scale and on a local scale too, they are really, really primordial in fintech. Okay, that means there are other things too, like what we call a regulatory sandbox, which allows fintech companies to test a series of things in relation to regulations set up by the country's monetary authorities, allowing a startup to come in and develop testing with a group of customers to test its model until it can move into the phase of a normal business. So it includes those things. But in these RegTech categories, to finish up, we can mention companies like Onfido, Chainalysis, and we have Comply Advantage. So I can mention these three companies that are in the RegTech sector.
Okay, Jeff gave a great overview of fintech. I didn't think fintech covered all these areas. So it's truly a revolution. There's one thing, Jeff, I'm going to ask you because we're talking about the global market. And when we talk about the global market, well, just before I ask the question, can you tell me what a global market is? Because many people talk about the global market, but they don't know what the global market is. Does it have a meaning for them for a developing country or just a different meaning for a developed country?
As we hear, global market means that everyone is included in it. It's a group of countries that come together, exchanging among themselves a range of goods and services, but they use a payment system that allows them to make these exchanges among themselves. For a large country like the United States, China, or Germany, the global market is an extension of the power they already have. Okay, they make the rules, they control the institutions, and then they export their financial models to other countries. A small country like Haiti or like Guadeloupe, the global market is an open door for them, but one that has many barriers. It's the same market on paper, but it's not the same access in reality. The system we've been using for a long time is the system we call the SWIFT system. That's what they use, which allows a country to conduct transactions with another country, allowing money to go from one country to another to pay a supplier in another country. Okay, that's what they used to use.
That's where I need to come in with a question. In the global market, there's a system that they use, which is a SWIFT system that allows transactions to be made from one country to another, right? But what about fintech? Does fintech itself follow the same line? Does it use SWIFT, or does fintech have another circuit it uses to make money circulate faster? Because from what I hear you saying about fintech, is that fintech helps money circulate faster. See what I'm saying? If someone has a smartphone, they don't need to go to the bank to be able to make a transaction, to be able to trade with someone in another country or an institution in another country. Does that person go through that same SWIFT system? Or is there another system that fintech uses to make the charges lower, actually easier for that person?
SWIFT and fintech are two different things. In fact, the word SWIFT, if you'll allow me to define the word SWIFT, SWIFT is an acronym. It stands for Society for Worldwide Interbank Financial Telecommunication. SWIFT itself is totally different compared to fintech. SWIFT is a bank-to-bank system where someone who is paying another person in a different country or making a transfer from their own country to another uses the SWIFT network. But to do it, they must physically go to a bank where they need a set of information about the person or supplier that the person is sending money to, but it goes through a network where when they go to the bank, they just give information about the person they're sending money to, and the info they give is the person's banking info. They give the person's SWIFT code because the person has a SWIFT code the bank gave them. They give the account number and all the details about the person, what country they live in, etc., and they do it. But it's the bank that uses its code because each bank has a specific code and each person with an account has a SWIFT number attached to them. What the bank does is it's not money moving from the bank to the person. The bank sends a payment order to its correspondent bank in the other country. For example, in the case of Haiti, most Haitian banks have a correspondent bank they're linked with in the United States. Generally, they use Bank of America or Citibank, where they have accounts in that correspondent bank. Then they send the info to the bank so they can take that money from their account to pay the supplier or person they want to pay. SWIFT itself is done through a bank, meaning if I need to do a SWIFT, I have to go to a bank, give the info of the person I'm sending money to, so they debit my account and credit the person's account abroad, where the bank where I have my account sends that payment order to its correspondent bank to perform that transaction for it, which is different from fintech. Fintech itself is a financial tool you have. It's an application you can have on your phone. Where you have your own account on your phone, I don't need any bank's intervention. I don't need to move from point A to point B through my phone. If I have a transaction for someone abroad, as we said, for all the sectors fintech covers, for example, if I'm sending money to someone, I don't need a third person or company. Through my phone, I make the transaction and it reaches the person directly if they use the same app as me. The only intermediary we use is the app we're both connected to. I take that amount from my account. It goes to your other account. This also happens with Swift, but the difference is the fees they charge for Swift to make the transaction. The fees are generally very high. But the difference with fintech is that it's faster and the fee is lower. With Swift, it can take 1 to 2 days for the transaction before the money reaches your account, but fintech happens in a minute and with a smaller fee. That's the big difference, meaning you don't need human intervention, you don't need a bank's intervention. In fintech, you go directly, you do it peer-to-peer with the person through an application, through a platform you're using, whether you're transferring money or paying for whatever you want to pay for, and it depends on what category you're in. And what else is there about Swift? Swift is under control because there's one country that directly controls the Swift system. That is to say, if you're using Swift, we have the Americans who control the Swift system. But with fintech itself, fintech is not under the control of a single country. Each country can develop its own fintech. Each country can develop its own financial systems that allow them to exchange with other countries and among themselves. A recent example is Brazil, which has a system called PIX. We'll talk about that later. If you ask me questions about it, I can give you more details.
In a moment, we're going to talk about some figures because normally we know there are many countries right now where fintech constitutes a large part of their GDP. And one of the things we also understand with the advent of fintech, the appearance of fintech, is that there are many countries, in fact, that went from being really poor countries to becoming emerging countries normally. We'll talk about that in a bit. But one of the things that caught my attention is still about the SWIFT system. As you said, the SWIFT system itself links the financial systems of countries. In India, for example, India needs to do a banking transaction with the United States. It uses the SWIFT system from bank to bank. Now, what links two fintech systems? A fintech system, let's say, for example, in Africa, with a fintech system in the United States, what links them? What makes this exchange, money, these trades, what links them? Is there a technology that links them together? And if this technology has a regulation, what regulates it?
Well, in fintech, there's what we call international standards that you're supposed to respect. To exchange from one country to another country, there are a series of standards they've established. Like, for example, there are licenses that are truly mandatory. There are 2 licenses in general. It's what I just mentioned earlier. It's what we call KYC, which is know your customer. You must have this license. The second license is what we call AML, which is anti-money laundering. Why are these really important? It can happen that a person has money in hand. They can develop an application and then decide to exchange money among themselves, going from one country to another country to pay, etc. But to be able to stop this, just like the banks have, this kind of license is to allow them to regulate a series of things to be able to stop disorder that can happen in the system and to avoid money laundering. They have to come up with global standards. If you want to exchange from one country to another country, there are a series of rules valid for everyone. As I said, it's these 2 licenses because each country, in relation to the money they have, has sovereignty over the money. The United States, the dollar is theirs. They have sovereignty over their money, meaning just because I have technology, I have internet, it's easy to develop an application. But for money to go from one person to another, there are rules because countries aren't lawless. So you must go through the monetary authorities in that country. Generally, that's a central bank, or there may be other entities in place to manage this, like in the United States. There are many monetary authorities in the US, but it depends on a country's structure to interconnect a fintech you have with another country. You must have that country's license to get authorization to implement your fintech because they don't want you laundering money there. They also don't want you stealing people's money because if people's money moves through your system, they need controls. They must protect not only the country to prevent too much chaos. Because if you're laundering money, you could put too much money into circulation within that country. And if there's too much money in circulation in that country, you can create inflation there. So they must have a set of norms, prudential norms they must apply. You must get that country's authorization to implement your fintech. So when you see established fintechs that allow international exchange, you have a platform you're using in the US that's connected so you can send to another country like India or Brazil, etc. It's because there are agreements reached between those countries and there are licenses that this fintech has, which allows them to have this interoperability between one country and another country. That's what it encompasses.
That's really interesting. Something you mentioned that really caught my attention is the question of regulation, because we know that without regulation, it would be total chaos. But while you were talking, something caught my attention regarding both banks and fintech. I know there are banks that are fintechs. For example, you just gave some examples. One fintech bank that comes to mind is SoFi. SoFi, you know SoFi well, it's a very well-known bank in the United States. which is a fintech. It doesn't have a branch, it doesn't have a physical structure, but it's an online bank where you can easily make investments.
It can be in the neobank category.
Neobank. But here's an extremely important question. For traditional banks, those that have physical structures, isn't fintech threatening the existence of these banks? Won't there come a time when these banks no longer exist? Because technology will surpass these banks, since a person won't need to go to a bank to handle a transaction, as long as they can be online, do everything, and find an online bank. Or rather, won't these banks also convert themselves into a fintech like an online bank? They won't have their physical structures for customers to come and go, etc.
I don't think fintech can make a bank disappear. On the contrary, fintech can be a complement to traditional banks. And even traditional banks today can embrace fintech using technology to reach more people. Fintech is a path that allows for what we're talking about, which is called financial inclusion, because there are a lot of people who are unbanked. They are unbanked for several reasons. They're unbanked because of maybe the environment where they live. There isn't a bank present there. They're unbanked because of fees that are too high. There are 1,000 reasons that can cause a person to be unbanked and not have access to a bank in the form we know it, in the traditional form we know. But through fintech itself, fintech allows even a bank, as we said, to extend itself to reach many more people. It can have more customers. The products and services it offers can reach more people. Fintech is a complement. I don't believe banks will disappear. What makes me say that banks won't disappear? Because in fintech, as we said, we're talking about regulation. Countries can regulate the role of a fintech, the movement of the amount of money that can go from point A to point B. That doesn't mean that because you have fintech, you need to move $1 billion on your fintech. I believe that a country's regulation can segment a series of things. It's just like you find in some countries, microcredit has its role and banks have their roles because micro goes to the small vendors. It gives loans to small vendors because it has a size, if we can say, that allows you to lend to a category of people but up to a certain amount. It's the same for fintech as well. The fact that the advent of fintech is here, it can allow a bank to use that, go faster, and reach more people. And as we were saying regarding the amount of money moving, the bank still has its role and must be interconnected with fintech. Because for me, they go hand in hand, one doesn't go without the other, and they can reach more customers. That's what I think regarding the question you asked.
Interesting. Yeah, because that's what I was going to say too. Because let's take the Zelle system, for example. It's a fintech that allows money to circulate, but it's banks. A person has a phone, and with their phone, they can make transactions, send money to another person using the person's phone number or email. They have it connected to the person's bank account, and you make the transaction very quickly.
If you'll allow me, that's what I just told you earlier. It's what's called interoperability. Zelle facilitates that interoperability. Before, I had to travel from where I am now to go to a bank if I needed to deposit money into an account. Okay, you, Romain, if I have some money that I owe you, okay, you say I can't receive the money. Either I'd have to withdraw it in cash. Okay, I wait until I meet with you to give you the money. Or you might tell me, go to such and such bank and deposit it into my account number. And I don't have that kind of time. And you need the money. But the fact that fintech is here makes interoperability much easier. I don't have to have a bank account at your bank to be able to take money from my account to get it to you. But through fintech, which is, let's say we take Zelle, for example, it allows me from my bank to take the money I have to give you and it lands in your account. This doesn't need to take 2 days or 3 days. You receive it in a minute. That's what fintech provides. The speed is much faster. Well, Zelle has almost no fees and you get it in a minute. If you had an emergency regarding the money, you can get the money in your account and handle the emergency you have. I don't need to wait 1 day, 2 days to have time to walk, to drive a car from point A to reach point B. To go get your account number, or I go to a bank near your house, I look for where your bank is located, in which area. You might not even be in the area near my house. I have to travel several kilometers to be able to find your bank until I manage to make the transaction. When the transaction arrives, for them to go do something else before it gets into your account, it takes several days. Or I go to my own bank, I make a transfer to your account. Okay, like in Haiti, for example. I can mention this. There's a system they call SPI. When you go do an SPI, you have to go to your bank for them to take the money from your account, to debit your account, to credit the other person's account. But the time for you to get it, you won't get it in a minute. You have to wait 1 day or 2 days until the money is available in your account. But with fintech, it allows you to go out, you do it in a minute, and you receive it in a minute.
Here we're talking about the speed of money circulation, at what speed money circulates in the economy. That is to say, fintech helps money circulate faster. This makes me understand that a country that lacks this technology called fintech, well, it's a country where the speed of money circulating within it is less compared to a country that has this technology and is using this technology constantly. For example, those of us in the United States, many other countries too, soon will give some statistics on this. We're looking at how fast, meaning someone needs money quickly, Zelle, another cash app, etc. There are a lot of systems, fintech that are there, financial systems that are there to help money circulate very fast. And when money circulates fast, well, the economy moves faster too. There's more economic activity also developing within the society. This makes me understand that many underdeveloped countries are because they have a problem at the level of their financial systems. The fact that money can't circulate. When money is paper, if the person doesn't have paper, they won't be able to actually make fast transactions. Whereas if the person had a fintech, a mobile, they could quickly make transactions, money would circulate faster, and so business would run better. Because there are many people who have businesses but can't make money in the business. It's because this technology itself isn't established. Because let's say if I come before a vendor here, I come to buy a product, okay, I come with some money. But with this money I have, the person must give me change. But if the person doesn't have change, they'll tell me they don't have change and it's gone. But if I come with a mobile here, the person tells me this is how much it costs. And then through my mobile, I send them their money. The person doesn't have to give me change and so on. And this protects the person too against theft and so on, against a lot of things too. This is really interesting. But don't you think we should take a break here? And in a bit, we'll talk about, regarding the examples you gave, I'd like you to provide some figures for those, how some countries around the world, regarding fintech development, how much it represents for them in terms of GDP. Has it increased the GDP in those countries? How does it contribute to the economic development of those countries?
Very well. We can look at that. We can address it. And as you said, regarding GDP, we can discuss the velocity aspect you just mentioned. I think that's related to a country's GDP, how money moves within a country, the speed at which money moves within a country, how many times money should circulate to create growth, and what causes a small country, like the one you mentioned earlier that's lagging, to lack real economic growth. That's a factor in why they lack economic development, the fact that they use too much cash and money doesn't circulate within the economy. I think today I'm looking forward to questions on this so we can clarify it. Thank you.
Okay, stay tuned. We'll be right back. Jeff just spoke to us at length about what a fintech is and which sectors the fintech itself covers. It was really interesting, but just before we get into concrete cases of countries that dared to change the rules, countries that dared to jump headfirst into fintech. Last time, before we did our show here on fintech, we were talking about artificial intelligence. Artificial intelligence, I see now, they've come to include it in the mobile internet equation, which has helped fintech advance even more. So I know you're a fan of artificial intelligence too, and even more so a fan of fintech. So do you have an idea about that?
Currently, all technologies now are trying to integrate artificial intelligence, especially with the chatbot issue, allowing for a series of quick responses that you can get. I'll take a quick example so we don't linger too long, like the integration of artificial intelligence in a fintech. In the past, you might need an explanation about a financial product or service, but if they integrate an AI into a fintech platform, it allows you to communicate and know all the financial services and products within that platform. And also, if you have a question, you have a concern, you have a problem regarding that, I think the AI can answer you quickly. Instead of staying on the line to call customer service until they answer your phone, you have to spend an hour, 30 minutes until someone answers you. The integration of AI within a fintech platform, it allows you to get quick answers. Based on the needs you have, it can channel you to what you specifically need within the fintech platform. For example, if you need something about credit, instead of browsing the whole fintech to find the credit features, with the chatbot you communicate, you go directly and it refers you exactly to what you need. These are features they've added. I'm citing these as examples that, as I said, all sectors indiscriminately are integrating in one form or another artificial intelligence within the sector to allow it to go faster and be accessible and make it easier for people using the sector. Just as fintech democratized finance, financial products, I'm thinking of financial literacy, etc., and specific products. I think the integration of artificial intelligence can facilitate that. It can allow people to be more educated and get faster services more specific to what they need through fintech.
What you said, I had an experience with it this week because I had a problem with one of my accounts and I just took my phone and called and it was an artificial intelligence communicating with me. And I told it exactly what I needed, and directly it sent me to the service I needed. And quickly, the problem I had was resolved. That shows you at what speed. That's what we're talking about with fintech. It allows the speed at which money circulates to be faster than the traditional system. Well, when you add artificial intelligence to this fintech equation, well, that makes it double the circulation of how activities are in the financial systems. That is really interesting. And now, Jeff, we're going to get into taking two examples of countries that dared to enter fintech and how that itself helped these countries to solve certain problems in the country and also contribute to the country's economy. First of all, let me ask you a question, Jeff. Is this global market we're talking about, is it the state or the private sector that chooses to connect its economy to the rest of the world? Or does it happen by chance? Or is it a strategic choice they make for their countries?
In most cases, the integration of an economy into the global market doesn't happen by chance. It's the result of a strategic choice where the state and the private sector play complementary roles. Often, the state sets the overall direction through public policies, laws, and trade agreements, while the private sector typically executes these plans through investment, innovation, and exports. To show you it's not by chance, for example, China decided to open its economy in 1978 under the leadership of an authority in place at the time. It decided to open its economy. This allowed China to become a major player in global trade. That was a decision that was truly extremely strategic. And to say it's not by chance that China is there. It's the decisions of an authority back in 1978 that allowed China to open its economy and become an essential player in global trade. The same goes for South Korea, which developed its exports thanks to state support for large companies. On the contrary, in the United States, it's often the private sector that drives integration through large multinational companies. There are also cases where countries open their economies under pressure from international organizations, especially small countries, you see, so they can keep up and be at the same international level. International organizations, very often it's the IMF, which is the International Monetary Fund, and there's the World Bank too. These organizations often push these small countries to follow suit so they can make the changes they're supposed to make. Well, recently I learned something about a small country, for example, where for money transfers they're currently considering using less cash to send money in the field of remittances. They're considering using stablecoins. They warned this small country. They told it, look, you have to get on board because we're going to use stablecoins. You have to put the infrastructure in place. They're forcing its hand because it's not the country itself looking at what's happening globally and deciding to follow suit. But if it doesn't want to follow suit, they have to force its hand.
I was actually going to ask you a question about stablecoins. For example, El Salvador, which adopted Bitcoin as its legal tender, for instance. So everyone sees that. Some people mock that, but how do you view that?
The way I see it, it falls under the country's strategic choices because every country has its strategic choices and every country has its reasons for making them. When I look at when El Salvador got into Bitcoin, many people ridiculed it. They gave it to them, but it's the country because every country has its monetary authorities. They have their own vision of the world. They have a vision regarding technology. They have their economic vision too. They decide the country's monetary authorities, along with the authorities in place, they can decide to make choices to orient their country in relation to what's happening across the world. I thought it was a good choice because when you look at how much Bitcoin went up at the time, I mean, I think they really took advantage of that. Well, currently Bitcoin has dropped. It's dropped almost by half. I believe it's around 80,000 if I'm not mistaken. 77 to 80,000 currently, but in past years, Bitcoin reached 120,000, 125,000 if I'm not mistaken. That means that at the time when they invested in, that means that Bitcoin went up. That means that it was really profitable for the country of El Salvador. That's stablecoin too. Let me open a parenthesis. When you use stablecoin, when you use cryptocurrency, it's not under any...
One second. Can you define stablecoin for us too? Because there are many people who hear about stablecoin, they don't really understand what a stablecoin is and how a country can use stablecoin to make money transfers without the person paying fees in traditional systems.
So as you hear the word, you hear stablecoin, that means that we see stable, we see coin which means money, that means stable, that means it's a money that is stable. In general, stable coins are fixed. Okay, it's a digital currency that they create that is associated with countries. It can happen that a country decides to develop a stable coin. You as an individual can decide to create a stable coin too. That's what's good with the advent of these technologies. Because it doesn't have to be a monetary authority that creates it. It can happen that I myself create my own money, my own stable coin. But as I said, stable is a money that is stable. It doesn't fluctuate. It doesn't vary. That means it's stable. That means there are stable coins like we have USDT, which is a stable coin. It's a company that developed it. It's pegged to the US dollar. Okay, that means one US dollar equals one stable coin. That means which is the currency, which is the cryptocurrency, which is this coin that they created. That's what a stable coin is. It's a digital currency that allows you to make transactions that is pegged to a currency. That means it has a value and that you can exchange with it in any country. That's what's interesting about stablecoin. It's not under a label, a central bank, but it can also happen that a central bank can create a stablecoin for itself too that represents it. Me as an actor, if I have an institution, I can decide to create a coin too. I can create a crypto. I can create a stablecoin. I say that I set a unit of value that is attached to the currency that I created. That means that the currency is stable. It doesn't vary. That's what makes it stable. That means that it doesn't keep varying up and down. I know that the unit of value of this money, if I say that I fix it equal to, I'll take an example of any currency. I can say $1. That means if I say this stable coin is equal to $1, that means that it's linked with the US dollar, it's pegged to the US dollar, but it's a digital currency. If it's someone in another country who uses pesos, you can create a stable coin that is equal to so many pesos. You too, as an individual, as I said, you can decide to create a coin that is for yourself. You give it a unit of value. You create a stable coin. You say, okay, it's associated with so many units of value. That means it's you who will determine what you're doing. That's what a stable coin is. It's a stable currency, which is different from cryptocurrency, which is, it's a crypto too. Yes, but with a slight difference because it's stable. The fact that it's stable means that it's stable.
It's just a little side note I made because you were talking about stablecoins. I wanted people to understand what a stablecoin is. Okay, Jeff, now we're going to look at some countries that have adopted fintech and how that has allowed those countries to increase their economic growth. I'll let you take the lead to give us some examples of some countries in the world and how fintech helps economic growth move forward for them.
As you said, Romain, fintech really, the advent of fintech has allowed many countries to go from point A to point B. That means it boosts their economies and makes them increase their GDP. I'll take an example like a case that everyone is always talking about, which is M-Pesa. M-Pesa, you'll see in all the research being done, in everything being read about fintech, this case is always striking. M-Pesa was launched in 2007, where M-Pesa managed to transform the country's economy and financial system through mobile phones, which has become a bank wallet for the person. When M-Pesa was created, Kenya went from 26% to more than 83% in its financial inclusion in less than 15 years. Where it now has more than 50 million active users, it contributes to more than 10% of its GDP, meaning you can see the advantage that a fintech like M-Pesa brings to Kenya. Like another fintech, we have what we call Flutterwave, which is a fintech created in Nigeria. They created their own fintech unicorn, where they process more than billions of Pan-African transactions. It's linked with a fintech here, which is Stripe. You can hear about Stripe very often here, which is also a fintech, where there are more than $12 billion of transactions made and valued at over $200 billion during its acquisition. That means I can show you that there's a lot of money moving with fintech and how fintech favors what we call the velocity of money. But there's a fintech that's really interesting. It's the Brazilian model, which is Pix. This fintech allows you to make instant and free payments 24/7. So it's the Brazilian government that developed it, where they're creating their own financial ecosystem to detach from the global financial system. It launched in 2020. In 18 months, it has 140 million users. As we said earlier, we talked about China, that China built a parallel fintech ecosystem, as we said, which allows people living in rural areas to be able to export globally. That means a person living in a rural area who didn't have access to banking financial products. The advent of fintech allows that person, if they have a small business or if they're a farmer, to be able to connect with the global market without needing to go to a bank to go through a SWIFT platform, thus allowing them to trade. I can give you figures regarding Alipay, which allows villagers, people living in rural areas, to export globally, where Alipay manages more than 1.3 billion users. It allows for $1 trillion in transactions per year for the rural area. And in the case of El Salvador, the fact that El Salvador adopted fintech, well, fintech, as I said, fintech in the category includes Bitcoin, includes cryptocurrency. It's the first country to do that. El Salvador has managed to cut diaspora transfer fees made to the country by up to 27%. So these are really, really interesting. When using fintech within the economy, the figures are truly interesting. Imagine an underdeveloped country that chooses fintech. It has its population living in rural areas. It gives them this access where people can sell on the international market, where they can sell their goods, have their business, and receive their payments. This could be a huge leap for that country's economy. It would lift that country out of a level of poverty and move it to a level of development that is truly extraordinary. I think that's the role fintech can play.
Before we started, we were talking about this. How does someone in a rural area get in touch with the world using a phone? And we're glad because you explained so well this connection between someone far away in the world. Because they have internet, because they have their phone, they can make monetary exchanges with someone else in another country. You gave many examples, many very good examples, and these are really important to know that technology itself, as it advances, there's technological progress being made. Well, they're there to make people's lives much simpler, and they're also there to increase people's purchasing power and make transactions faster. Okay, but Jeff, what do you think about underdeveloped countries that haven't really used fintech on a large scale yet? What are they missing and what is possible for them?
I think that for an underdeveloped country to be able to use fintech, it needs a vision, a public policy, public-private partnerships so they have a vision around the issue. Is fintech good for them? Because there are expenses to be made, infrastructure to be created. Because as I told you, for fintech to happen, the infrastructure is really important. Fintech itself is no longer an option for a small country. It is an infrastructure in and of itself. Just as a modern economy cannot develop without electricity or drinking water, you cannot have an inclusive economy without a permanent digital system. It's not enough just for the person to have a phone to do fintech, but there are some setups that need to be done. It needs a lot of things. First, infrastructure like high-end internet. Another thing, you have to develop rules so fintechs can be implemented. As mentioned, laws must be passed to protect customers. There must be regulation around these as well. And the identity issue, you must provide access to know who's using the fintech. You should have what's called a sandbox, which allows startup companies that will create fintechs. They can test an idea related to the population's needs within the sandbox, because it's not the traditional banks that will develop fintech, it's startups, it's people who will create fintechs. Another thing, there must be incentives within the country's economy. The state must really be present to have what's called open banking, which allows for an API that lets my bank connect with the fintech I'm using. Like you, who has a bank account and a fintech, interoperability must happen. There must be a national awareness, a vision, all actors involved, and the state must be there with rules created around it and infrastructure built. Without these, a country that wants to move forward won't be able to. And this becomes an imperative to implement fintech, because the way the world moves, if you don't have fintech, you're behind. Because money must move within the economy. Without fintech, there's no e-commerce. Without fintech, there's no economic growth, meaning you'll always have a moribund economy if you don't implement fintech. Fintech is the means that allows you to go faster and make money, circulate faster within an economy, allowing you to create wealth and economic growth.
Okay, so you're saying that in the current times we live in, with technological development in the world, a country can't develop without going through fintech. So fintech is supposed to be indispensable. It's like drinking water, it's like electricity. People need electricity to function.
You're talking about development without talking about electricity, without talking about roads, which are means of communication. It's the same way. Without digital payments that we attribute to fintech, without these digital tools that allow transactions to happen, you can't have development at home.
Let's take the case of some developing countries that have a high percentage of diaspora living in other countries and sending money to those countries. Well, if I take a case like Haiti, which is one of the countries that receives more than $3 billion a year from the diaspora all over the world, which represents 25% of its GDP. While no wealth is being produced, this money comes in, but no wealth is really being produced. And how can you transform this flow into real investment? How can fintech transform it into real investment?
Haiti receives, as you said, more than $3 billion. And I believe recently, the last reports I was looking at, it's increased to about $5 billion currently, meaning that this money represents, as you said, more than 25% of Haiti's GDP. But the problem, as we've said, isn't the amount of money. It's more about the way the money flows in and out. Currently, most money transfers are spent on immediate consumption, food, school, healthcare, and they go to merchants who buy imported products, because Haiti's economy is based on imports. This means the money just comes in and goes right back out. Money doesn't really circulate, like we were saying earlier about the velocity of money, the movement of money. As I told you, the minimum money should circulate in an economy is 6 times. In Haiti, it's 1 to 2 times. So these are problems. To transform this, what you can do is we need 3 things. First, you need a cheaper transfer channel. If fees drop from 7% to 1%, that already adds millions of dollars to the economy. The second way is to create a way for people to save, because fintech can allow them to do that. With accessible investments for the diaspora, There's something I was thinking about, like Haiti could do, create what we could call a diaspora bond, since the diaspora has capital. So if they created a diaspora bond, I think that could help.
What is a diaspora bond?
Well, a diaspora bond is a debt security issued by a state specifically for people living abroad. For example, as we talk about the diaspora, citizens of the country living abroad, it creates this bond for them. The goal of a diaspora bond is to mobilize diaspora capital to finance development projects like infrastructure or education. Like we said about fintech, we need infrastructure. Creating a diaspora bond could allow the state to use that money to create the fintech infrastructure it wants. It's a market based on trust and the attachment the diaspora has to its country of origin. For example, we have countries like India and Israel that already use this to raise money for their own development. A country like Haiti that receives about 4 to 5 billion in transfers. From the diaspora, which means people are attached to those back home, this financial tool, if they considered it to develop a fintech infrastructure, they could use such a financial tool to create development and build the infrastructure they want. And there are countries, as I said, India and Israel, that use it because the money transfers the Indian diaspora sends to India is estimated at over $100 billion a year. That means it's a huge market.
We don't only have India either. We have many other countries. For example, when you take African countries too, money transfers happen a lot in those countries. In fact, especially where there's a lot of migration, where there are large diasporas, well, the diasporas always use it to send money to their countries to help family, friends, etc. As you said, this can be an incentive for the diasporas too.
I think this can allow not only for creating infrastructure, but also creating wealth through these kinds of things. Because when you create infrastructure, more startups will be created, meaning there are young people with ideas, and it's going to create a series of things. You'll have innovation within the country. There must be institutional trust. Because for the people themselves, as you said, to create a strong diaspora, there's a series of tasks that must be done at the institutional level. This means that for the diaspora to have confidence, when they send their money, they know that if they invest in bonds, the interest you say you'll give them, they know they'll get it. And the work you'll do with the money you're seeking, it's not about taking money for show, but you can take that money and invest in infrastructure. Since we're talking about fintech, I think, as I said earlier, there must be a vision, there must be infrastructure. And for infrastructure, there must be money. I think using a means like this can allow you to change the game, to transform the economy, bring in fintech infrastructure, and move forward.
We have many underdeveloped countries with a lot of young people who are really very intelligent, who are developing activities. But unfortunately, the fact that they don't have fintech, it restricts their work. It restricts them from connecting with the global market. Just imagine that these young people could earn just as much money while staying in their own countries. Because many of them end up leaving for developed countries. It's because they have the imagination, they can create business activities, but there's no fintech infrastructure in their countries to connect them with the rest of the world. And once they find a fintech that can connect them with the world, it's certain they'll earn money. They won't even need to move to another developed country because what they would be looking for in a developed country, they already have right there in their home country. Is money. The majority of people who go abroad is because they can't earn money in their country, so they're forced to leave to earn money to send back to their families and so on. So if someone can do that in their country with a financial system that's really fast, that they can use to connect with the world, well, that person won't need to leave. They'll just stay at home, run their business, and so on. There are many countries where the population is mostly young people, and they're very intelligent. They're starting to develop various business activities. When I look at our country, for example, you'll see many young people starting to develop online businesses, but they're held back by institutional weaknesses that prevent these businesses from connecting with the rest of the world. Just like you said, I think if fintech can establish itself properly in these countries, then the young people won't need to move away. So we see that fintech is part of the engine of development for a country. So Jeff, I'm going to ask you a question that might sound a bit simple. What's the biggest mistake a country or a government of a developing nation can make regarding the fintech revolution? Or rather, could it ignore it, over-regulate it, or try to control everything in fintech? Do you think if it does any of these things, they are fundamental errors that could hinder the development of fintech in that country?
The biggest mistake a government can make in the face of the fintech revolution is failing to find a good balance between control and innovation, or it simply doesn't adapt to change at all. There are some clear mistakes that are often made. Mistakes like too many regulations, over-regulation. When the state sets too many barriers, licensing becomes difficult or it bans new technology. It stifles innovation. Because a young person with an idea won't be able to move forward, they won't be able to do it. Like, for example, if a state decides to implement a regulatory sandbox, where for a startup to have access to it, it needs how many millions of dollars, or if it's in Haiti, it needs how many millions of gourds just to test, because it's an idea that the person is testing, which means it's already pushing the startup to go elsewhere. This means this idea, either it dies, or if the person has the capacity, they go elsewhere to develop it, somewhere that gives them a better way to develop it. As we spoke about over-regulation, there's under-regulation too. If there are too few regulations, because you shouldn't have too many and you shouldn't have too few. When there isn't enough of a legal framework, that can create fraud, and as we were saying earlier, it facilitates money laundering. Another thing we can say is ignoring financial inclusion. If fintech doesn't serve people who don't have bank accounts, its revolution will only benefit an elite. Because the role of fintech is the democratization it brings. It gives people who didn't have access to banks access to banks. That's why fintech goes hand in hand with what we call financial inclusion. You have to move towards what's called financial literacy too, because when someone uses it, they need the literacy to have knowledge of products, services, and how to use them. Another mistake they can make is not investing in digital infrastructure. As we were saying earlier, to have fintech, we must have digital infrastructure, like good internet and digital identity, because without those, fintech cannot grow. And also, a mistake they can make is not understanding the risks and opportunities of data. Okay, poor management of people's data. You must be able to protect people's data. You must manage people's data, people's privacy. If you don't take that into account, it can create a crisis of confidence within the system.
I'm going to ask you a really interesting question because the way you're pouring it out on me here, it means you have so much in your head. Let's suppose you had $1 billion, you had political power in your hands. They tell you to transform the economy of an underdeveloped country in 5 years through fintech. What would you start with? First day, first gesture, what would you do?
First day, what I would do? In general, underdeveloped countries have identity problems. And the first action I would take, I would invest in national digital identity. Because as we said, KYC is really important to avoid fraud, to know the people using the platform. If I can't verify someone's identity, you can't have fintech, it's not possible. Second step, I would create a national platform. A permanent one that allows you to have interoperability, which allows all operators to be interconnected instantly. And the third step, I would open access to credit for merchants, because in fintech too, so you can create incentives, a series of things within the economy too, because you can create fintechs specialized in credit, because that itself is part of what we call the real economy, and create a platform that allows people to trade with each other. So someone living in a rural area or a small country can sell their products or services to someone living in a large country. The final step I take would be to invest in what we call digital financial education, because once you've done all that, people have the infrastructure and their identity, but now they need to be aware and financially educated about it. So that's where I'd invest the money I'd have to create something truly innovative that reaches many more people and is really impactful, providing access to everyone and driving economic growth and development for our country.
Interesting. Jeff, in the next 10 years, which countries do you think are underestimated today that will create a global economic surprise through fintech?
I think a country like Ethiopia, with a population estimated at 120 million people and an average age of 19, which is the second largest country in Africa, where the government just opened its financial sector after years of state monopoly. With a truly powerful diaspora that has the capacity to invest, I think Ethiopia is a country that could really break through in that sense. Looking at M-Pesa just entering Ethiopia, their systems are modernizing, and if regulations stay smart and local fintech professionals get the right support, Ethiopia could make a real difference in 10 years and see great results from the fintech being implemented there.
Thanks, Jeff. That was the final question, and I'm glad we covered it. So, in 10 years, Jeff tells us that one of the countries he thinks is on the path to emerging and closing the gap with developed nations is Ethiopia. Because just as Kenya, India, and Brazil have connected themselves, Ethiopia can choose to do the same. Now, as for other developing countries, what are we waiting for? Are we going to get connected or not? So, I'm going to tell you something that many economists never say this, but poor countries aren't poor because they lack resources or creative youth who can innovate. They're poor because they're disconnected from the market, from capital, and from technology. That's what makes them poor. But the digital revolution offers a path for all developing countries to move toward development. And while it took currently developed countries a long time to develop nowadays, technology makes things much easier. If we embrace the path of technology, then development itself will happen much faster. So, Jeff, I'll let you close with a final word on fintech, since I know that's your specialty. Go ahead and speak to the audience. Give them one last word on fintech.
So, as we've discussed, artificial intelligence being the world today, fintech is the world too. Any country that needs to develop, that needs to be competitive on the international market, I think fintech is the means, it's the way. A small country that's lagging in progress, that's struggling with its economy, I think that implementing fintech can make it advance very quickly. If it would need 100 years to be able to develop its country, I think if it implements fintech and does what it's supposed to do, it can advance rapidly. Countries, the big countries are making efforts to provide banking, they're promoting fintech, they're making innovations. I think it's just as important for small countries with their traditional banking methods. They must follow suit to revitalize their economies and to be able to grow and play in the big leagues just like all the other countries, and so their citizens can live comfortably and peacefully. If they use fintech, I think that's one of the ways that allows them to advance very quickly. Thank you, Ome, for the invitation today to talk about fintech.
Thank you, Jeff. Goodbye, everyone.